Hello and welcome to the Global Dialogue. I'm Shereen Bhan, and joining me on the program today is the Global CEO of Stanchart, Bill Winters. Bill, thanks so much for joining us here on CNBC-TV18. It's great to have you join us on the program. You've missed the G20 quite literally by a whisker. A lot actually got done as part of the New Delhi Leaders' Declaration, including on finance. Of course, the need for more global cooperation on things like crypto regulation, multilateral development bank reforms, and so on and so forth. What's your big takeaway?
First of all, it's really nice to be here, basking in the glow of a really successful G20s. Certainly everything that we saw and everything that I've heard subsequently from government leaders, business leaders, etc., since I've been in India, is super reassuring. And you're right, I missed the event. I don't think a lowly banker was invited to the head of state meeting, but I had the great pleasure and privilege of participating in something that's called the B20, which is a group of business leaders. In the case of this B20 meeting, working as a co-chair of a group with a COTAC that was tasked with coming up with recommendations for the G20 on how to marshal global financial resources for the developing world broadly, with a focus on sustainability and transition financing, but not limited to that. And I was very happy to see that the recommendations that we made into the G20 were picked up, discussed, and some of which really made their way into the programs, like some of the things that you mentioned. So the reform of the multilateral development banks, it's prospective, right? Yeah. It's an idea, but we have a new head of the World Bank who's quite committed to stepping up the level of engagement, in particular in helping developing nations fight climate change, but also deal with the consequences of climate change. Right? As much as we think we can avoid temperatures going up more than 1.5 degrees, I question whether that's even possible anymore, given how far behind we are. Nevertheless, even in today's temperatures, as we're seeing yesterday in Libya, last week in Hong Kong, and the week before that in the south of the U.S., the consequences of rising temperatures are absolutely profound, and we have to spend money today to protect economies and communities. And these are actually kind of no-brainer investments, if I could call it that. The money that we spend today will save 10 times as much money down the road. So the fact that the G20 is tackling these issues in a relatively concrete way is very reassuring to me, and I'm happy that the business community is feeding into some of that.
You know, speaking of the partnership between the G20 and the B20, and you referenced the World Bank's new president, Ajay Banga, and I had a conversation with him 24 hours ago where he talked about the need for, of course, a bigger balance sheet as far as the World Bank is concerned. But he said, look, that's not going to be enough. If the bank's aperture needs to consider things like climate finance, etc., and not just poverty alleviation, you need the private sector's involvement to deal with some of these challenges and with some of these issues. You know, as part of the discussions, the deliberations and the recommendations of the B20 and the task force that you were part of with Uday Kotak made, where is the money going to come from?
Yeah, the money is there. There is enough money. The public sector has some money earmarked, but nowhere near enough. Of course, part of the MDB reform is how do we get more capital into the World Bank, into the African Development Bank, into the AIIB or the New Development Bank, or these newer MDBs. And that's a question of the shareholders, governments in other words, to increase the funding. But Ajay is absolutely correct. That won't be enough. What we really need to do is to have that public sector money crowd in or bring along with it many multiples of the public sector money in private sector money. So today, if the World Bank, on average, lends $1, that's crowding in less than $1, 95 cents, of private sector funding. That's crazy, right? $1 of World Bank funding should be crowding in $15 of private sector funding. In order to do that, the public sector funding is going to have a different risk profile than they've had historically. So when we talk about MDB reform, we're talking about increasing the amount of capital that they have, but also increasing their ability to bring the private sector along. Now, Standard Chartered Bank, that's what we do. So we're the largest issuer of World Bank guarantees in the world. And a lot of those projects are targeted at core infrastructure in developing economies, and increasingly into sustainable, environmentally sustainable infrastructure projects. So we know how the system works, and if you have somebody who's prepared to take, often it's just taking the political risk, or taking the risk around the development of a project, which is the most difficult thing to finance in a big infrastructure project. It's the completion of the building, technical challenges. If we have people that can take components of that risk, then we can bring in all the pension funds, the insurance companies, the banks, other generic participants in the capital markets who have ESG mandates.
Yeah.
They want to invest in sustainable things, but they don't have the technical competence themselves to get into these really complex elements of the capital structure. So our mission as a bank is to work with borrowers, work with the multilateral development banks, work with export credit agencies, work with capital markets investors, ESG and non-ESG, bring the package together so that we can get that real crowding in. And we're talking a need for $100 to $150 trillion.
Yeah.
Right? This is like serious money.
Yeah.
We can only do that if we harness all the resources of the private sector, catalyzed by the public sector. But we can get this done. There's a way through this.
Let's talk about the global outlook at this point in time. For the bank, you've had a very strong first half. Income up 18%, profit up 28% year on year. If you look at the global economy, the US, Janet Yellen talking about a more certain soft landing.
Yep.
India here, growth is looking strong.
Yep.
China, we don't know whether we've seen the worst of the unraveling or more to come. Size up for me the global economy, the global mood today.
Yeah, I'm pretty optimistic overall, which is not to say there aren't real tensions. So inflation is still running high. Wage cost inflation is also running hot for some really good reasons. I don't think we fully absorbed the COVID impact and the post-COVID impact. The supply chain disruptions that really afflicted the market and contributed to this big inflation problem, I'd say have largely resolved, but there's still a tail of working through that's putting some pressure. The relative weak spot compared to, I think, what some of the expectations were earlier in the year has been China, where economic growth has been a little bit sluggish. I think that's been driven by a few things. One is the ongoing supply chain challenges. I think China is just it came out of COVID late, so it's taking a little bit longer to process that. Second is this overhang in the real estate market. So there's been what would have been if it happened in the West, it would have been a real estate crisis. We'd have a collapse in real estate, and we've seen it in my 40 years in banking. I think I probably lived through 5 real estate crises of a major variety, the most substantial of which obviously was the great financial crisis. And real estate crises are bad in and of themselves, but when they then infect the financial system, then they're really bad, like maybe 20 times worse, as we saw in 2008, 9, 10. And I think the Chinese are quite determined to decompress their property market without destabilizing the financial sector. So far, so good. Now,
but do you believe that they will be able to manage this decoupling that you speak of?
I think they're doing a good job so far, but it's very painful. So we've taken losses on commercial real estate in China.
Will you need to provision more?
Well, who knows? We've provisioned. We think we're properly provided right now. We don't have very large exposure, but we have enough so that we felt it. It was really the only loan loss provisions that we've taken over the last 18 months, but for a couple of the sovereigns that have restructured in Sri Lanka and Africa. But the biggest losses that we've taken are in Chinese commercial real estate. But the market seems to have broadly stabilized. The stimulus packages are having an effect, but it's not lifting the market back up. So, but the financial system in China is still very strong, so that there's no concern that this is spilling over to the banking sector or the Chinese have also done a very good job of reining in the non-bank sector. So I'd say the jury's out on how long it will take for China to get back to its potential growth rate and where the growth will go from there. But they're managing things quite directly, and I would say so far so good.
Let's address the issue of what we saw happen as far as the banks were concerned. And then you said, I think it was in May, you said that you were a net receiver of deposits during this period of global angst.
Yeah.
What do you anticipate now in terms of what this could potentially mean for you, for market share, etc., as we move forward? And what are the lessons to have been learned through this crisis?
Well, I think it's this regional bank crisis, as I think it's come to be known. Although obviously the big victim was Credit Suisse, in that very different set of problems. Credit Suisse, they had serious problems with the business model for some time, but the U.S. regional banks was a surprise to the market. And we know fundamentally it was a crisis of confidence. There was a liquidity mismatch and some misallocation of resources, in particular in Silicon Valley Bank, and the consequences were clear. The U.S. acted very assertively to effectively backstop the deposit system in the United States. That will come with a tail.
Yeah.
The tail is moral hazard. But regulators are very, very aware of that and will work around it. Of course, everyone would prefer that had not happened. The Credit Suisse is obviously different, ultimately led to a crisis in confidence. The Swiss authorities managed to bring this together in terms of a merger with UBS. But it does raise the question, what will be the market reaction The answer is, so far, not much, right? Because there's a sense that governments are aware that we cannot have another Lehman Brothers moment where there are questions about the financial system. But then that leaves the question, well, what are regulators going to do to make sure that we don't have another Silicon Valley Bank or First Republic or Credit Suisse? The jury's still out on that one. Will they increase the amount of cash that we have to hold in the bank? Not a problem for us because we're holding a lot of extra cash in the bank anyway. But will the requirements go up? Possibly. Will we be required to hold more capital? I don't think it's connected to the U.S. regional banking crisis, but we've seen that the U.S. Fed has, and the FDIC, have indicated how they're going to treat the new global system of banking reforms, known as Basel 3.1, with a significant increase in the required capital for, in particular, large banks in the U.S. Some of the U.S. bank CEOs have objected to that quite strongly. Is that in response to the regional bank crisis in the U.S.? I don't think so, but maybe the fact that they're coming at about the same time suggests that it's in the back of regulators' minds. Will there be more of that in the UK, in Europe, in Asia? Perhaps, although we haven't seen any sign of that yet. Because for the most part, the European, American, Asian banks are very well capitalized, very liquid. We don't have the kind of mismatches that we saw with Silicon Valley Bank, and we don't have the kind of structural problems that we saw with Credit Suisse. In fact, we've cleaned ourselves up completely. We don't have major litigation outstanding. We have had virtually no credit losses for the past 5 years. We have growing and strong profitability. We've got a really good market share, and we're super liquid. So I feel pretty good.